I'm Adam Myers, an Executive Director at Pengana. Thank you for joining us for this webinar update with Steve Black, the Co-Portfolio Manager of the Pengana Emerging Companies Fund. From a format perspective, Steve will keep his prepared section to around 25 minutes today, so we will have plenty of time for Q&A at the end. So please, any questions that you have about the fund, the investment environment, or specific exposures, enter them into the Q&A box, which you can access from the icon on your screen, and hopefully we will have a very interesting conversation at the end. We will wind up by no later than 12:45. Steve, over to you.
So this is part of our usual 6-month update for the Pengana Emerging Companies Fund. And this slide here will probably be a slide that many of you know and have seen before, but it's just worth recapping as to who we are. So Ed Prendergast and myself, we started this fund 21 years ago, and we're true believers in the 3 Ps of funds management. So the people, process, and performance. So we certainly believe that over that journey of 21 years, the stability in those 3 Ps is critical to the success of this fund. And I'll move into a little more detail later on, but suffice to say that the enduring nature of this fund, I think, largely comes about through obviously the team being intact, being just Ed and myself, and then also the process we adopt, which is very much a risk-based sort of bottom-up approach to stock picking, where we have a very, very keen eye on the risks at a stock level, and that sort of defensive sort of approach to investing has obviously served us very well over the 21 years, delivering returns of 13% per annum, which is greater than 7% per annum above benchmark after fees. So over this last 6 months, the fund was up 15.5% against the small ordinary 16.7, small industrials 13.3. It's probably not a bad time to remind investors and listeners that we don't invest in the gold sector. We don't invest in the resource sector, and gold is about 15% of the small ordinaries index. And for the calendar year to date, the small gold stocks are up 90%, which is extraordinary, obviously, due to the obvious factors overseas. In terms of the winners and the losers, you can see there's always a lot of volatility in our space. And then our normal cadence in terms of we average sort of on typically about 1 company meeting a day, and that's obviously our where we get our idea generation from for the fund. And then if we move to the longer term picture, you can see there that the consistency of outcomes in terms of performance at the top row there of that table. And last 12 months has clearly been a bit of a blow-off year, up 27.5%, a strong 9% above the small industrials and about 4% above the small ordinaries. And then the usual upward sloping chart of what $100,000 invested in 2004 would look like today. And the power of the compounding of that alpha generation is clearly in evidence on that chart. So just as a reminder of our process and how we go about investing, and I won't dwell on this slide too much other than to say that it's cash flow that drives our decision making. Cash flow and management quality. So we will largely ignore PE ratios, for instance. They hide a lot of sort of corporate sins and clever accounting. We much prefer to watch and focus on the modelling of the cash flow generation over time. And then we look to build a portfolio of 50 to 60 stocks. We have a very large universe from which to pick those stocks. And so we're looking at about active weights, typically between 1% and 5% in those companies. And we'll always be fully invested in the market. So this is not a fund that is attempting to gain market direction. We'll leave that to other experts, but our skill set is bottom-up stock selection in the small industrial end of the market. So we will stay within our lanes. The I think one of the reasons for the longevity of the fund is the culture that Ed and I share. Obviously, we're a small team. We're very experienced. We'd be the longest serving small cap team in Australia now. I think that's that simplicity that has ensured that continuity and consistency of outcomes. Not only do we have that alignment of interest in terms of Ed and I share 25% interest in the business, Pengana Capital obviously owns the other 50%, but also our own personal exposure to small Australian industrial companies is through the fund. And we're not looking to sort of build out any other funds, or we're not building empires or our brand. We'll just stick to where we know we can add value. And then finally, throwaway line, we keep it fun. We don't work crazy hours. We don't want to run the risk of burning out. We have balance in our lives, and I think that is incredibly important in terms of sustaining the work ethic and focus and passion that we have. So we just sort of raise our eyes a bit to the more recent times, and the reporting season just concluded. It was obviously incredibly volatile reporting season, one of the most volatile we've seen. And in actual fact, there was 46% of companies that reported their results had a movement in their share price up or down 5% on the day, which is extraordinary level of volatility in the market. And that was a level of volatility that was shared amongst the large cap stocks as well. We're somewhat used to the volatility, but the large cap managers that investing in Woolworths and Commonwealth Banks and James Hardie, they've in CSL, they've seen a lot of volatility through that important month of August as well. The margin backdrop is certainly stabilizing, which is very good for companies. So a lot of that inflation, COVID-led inflation, has worked its way through the system. Prices have adjusted, and margins now are nice and stable from which to predict going forward. And then the normal, when I say the normal, it was the same two areas of weakness I mentioned this time last year have continued, and that's Victoria and New Zealand. A lot of companies we're seeing are calling out those two areas of being very disappointing for them. And in Victoria, which is where I am today, there's certainly a very strong focus on crime in the store, higher taxes, lower productivity. That's weighing on some of the companies' divisions that operate in the Victorian market. And then in New Zealand, they've been flatlining for a little while now, so they really need house prices to rise, I think, before consumers will start spending and the economy will turn over again. The markets have clearly bounced hard, particularly from that Liberation Day driven April low. And I think the markets come to realise that the obsession with Donald Trump through media outlets is certainly over the top. I mean, he's clearly one important input to what contributes to a movement in an economy and prospects for an economy and country. But I think the markets come to realise that economies are complex, they're messy, there's a lot of contributing factors, and can be shaped by other events like geopolitical, AI, currencies, bond markets, which I think are have driven markets in more recent times into a lower interest rate environment. Equity markets tend to perform quite well, all else being equal. One area of the market that we've been wary on for probably 2 or 3 years now, since COVID at least, has been the specialty retail end of the Australian market. There's a lot of small cap retail companies. And as I said, we're underweight this space. And most of it is explained by the fact that we think they're still over-earning. This chart on the left here just highlights, since COVID, how the volume of demand has spiked incredibly after COVID, and it's never returned to the trend line. And then you overlay that to the right-hand side there, when you look at the profit margins that these specialty retailers are earning, and that's an aggregated profit picture there. The EBIT margin average pre-COVID was 7%, projected to be about 8.5% post-COVID. And I simply can't see any structural reason why they should be earning more now than they were. I think the answer is probably on a large fixed cost base. That excess volume is just driving better returns. So we'd be concerned that that will normalise over time. There weren't many briefings through reporting season where management weren't talking AI. I think they've got to be seen to be leaning into AI, even if they're not spending vast amounts of money. No doubt there's a lot of boardroom pressure on CEOs to have a strategy, and even investors are asking, obviously, a lot of questions around how they're positioned in AI. My personal view is that it's very early in its evolution, AI. It's in the interest, clearly, of all stakeholders, including, obviously, the large data centers and large language model companies that are training algorithms to talk up AI, because it's such a capital hungry sector. They need to raise capital to fund that growth, the cost of that growth. So to achieve that, they want a high share price, they want which lowers their cost of equity, and they can sustain that capex that's required, which is well documented or charted on that top right chart there. You can see the large AI firms and how their capex has exploded compared to, in the US, non-AI related firms. Our questioning is, clearly we've been talking to a lot of the companies. We've been probably referring that they're not early adopters. I think there's potentially going to be a lot of money wasted until the user cases come forward to justify that spend. A lot of return on investment of companies is well below what they would have expected in terms of leaning into the AI opportunity. So our view is certainly that it'll take time. It's real, no doubt, but I think it's in its infancy, and the hype around it is certainly, in my view, over the top. What we don't know from a valuation perspective is whether or not we're a 1996, 1997, when I was managing a fund at Goldman Sachs, or in early 2000. So whether or not the excitement is early or late, a lot can happen in a valuation sense between before a cycle tips over or the bubble bursts, but it certainly has all the hallmarks of something that's where the market's getting overexcited. Just a reality check, that bottom right chart there just sort of highlights the internet picture where, when the World Wide Web was discovered, markets got incredibly excited. Valuations were over the top, and we had the inevitable bust in early 2000. That didn't stop the internet, obviously, having incredible ongoing benefit to business. And you can see there with this is in the US, but retail spend online now is running at 25%. That's taken 25 years. So just a reality check that often in the real world, when a new platform discovered, then it just takes time for it to actually evolve and for companies and corporates to get the benefit of it. So what I'm looking at here now is the relative performance of small caps and large caps. On the left there, large caps since COVID have done incredibly well versus small caps. We've spoken about the reasons for that in the past, but I think importantly from here, as we sit here today, the environment is far more conducive for small caps to close that gap. So not only do we have GDP growth in Australia now running at the largest or the strongest since 22, the last quarter that was published, but we've also got consumer confidence rising, and critically, the top right there, that chart just showing the relative earnings growth of small caps versus large caps in the industrial space, where in the 25-year, very negative growth for the top 20 industrial companies, are down about 6.5%. And then their prospects rise next year, but slightly above zero. But you can contrast that to the small caps on the far right there, and the earnings picture is certainly a lot stronger. And that earnings growth, I think, is starting to be priced into markets. And even in the last 12 months now, we've seen small industrials up about 11%, 20% against the large industrials, about 11%. So we'll expect that and hope for that gap to continue to close. Here's our normal chart looking at the composition of the fund. Won't surprise you to learn that we still have around 2/3 of the fund in that defensive growth category, which is what we prefer. And modelling is, in a relative sense, going to be always far more accurate when the inputs to that model aren't going to be as easily thrown around by the vagaries of a ever-shifting global backdrop or economy. Okay, so we move over to the fun stuff now, the stocks. So some recent inclusions and removals. This is in the last 6 months. And then stocks that we've increased that were already in the portfolio, and those stocks that are in the portfolio but are lesser weight in terms of the recent reductions. And I've got a few breakout slides where I can talk through some of these companies shortly. So just moving to a few core positions in the fund, and Breville's topical because it's the one stock we have that is certainly at the coalface of the tariff war that's playing out. They generate about half their earnings out of the US, selling particularly high-end coffee machines into the US market. So, and a lot of their product was sourced out of China. So they were really obviously going to be impacted by the tariffs that were initially imposed in 18, and then obviously tripled since then with Trump 2.0. So how are they managing that? Well, they're pivoting their business in terms of manufacturing to other geographic regions around Asia and Mexico, and also will increase prices, remembering that in effect the Trumps is a consumption tax on the US consumer, and will back management that has been in place here since before we bought the stock. So the best part of 8-9 years, and through that period they've been able to navigate Brexit, obviously COVID, and then the tariffs, as I said, that Trump initially put in place. So, and whilst the share price has done very well over that time, so we're not saying they will not be affected, they will, but we think the market's overreacted to the extent that there will be a long-term problem. Catapult's a stock that I guess our timing is quite good there. We don't always buy a stock just before the hockey stick presents itself in a share price sense. Stock we've been watching for a long time. In fact, back when it listed in December 2014, we met them then. Haven't committed to it, partly because it was loss-making. We don't invest in loss-making companies. A lot of CEO turnover. But what excited us was a new CEO with a real commercial background, very focused on the in-markets and marketing and distribution. And that's played out in spades there in terms of the growth they've enjoyed. Very profitable company now. And what is very rare, which is the chart on the right there, is where you get an Australian tech company that dominates in all geographic regions, or they're the largest player there in terms of their market share of professional team sports for their wearable stat tracking devices. Even a Pro Medicus or a Technology One or a WiseTech, these really successful tech stories out of Australia have always found it hard to replicate success into other countries. But I think it really resonates globally, the tech stack that they have, and with industry growth growing at 15% per annum and their penetration improving, we'll still see a lot of strong upside for Catapult, notwithstanding its recent share price rise. Regis Healthcare is a stock we've recently bought. It's the largest listed aged care business on the Australian market. You may remember that this is a sector that was in a real strong focus, even pre-COVID, with a Royal Commission on aged care in Australia, partly because there was a chronic underbuild of new aged care facilities and therefore beds in the Australian market. On that chart on the left there, you can see, and this is from the Royal Commission papers, that there's an underlying need of 9,300 new beds per annum. And at the moment, well, this was to the end of financial year 24, but it hasn't improved much in 25. There was a collective 6,500 built only in the last 4 years. Now, that came about because all the operators in the market weren't making the cash or generating the returns they needed. As you can see on that chart on the right there from Regis Healthcare, which is the probably the best performing aged care company in Australia. So the model need to be changed. There's been a whole rework by the government of the funding model in terms of daycare, but also in terms of promoting and sponsoring new builds, greenfields in the marketplace, so as to meet that new bed requirement as the Australian population ages. So that's a happy environment for cash flow to improve, and we expect further announcements from the company to stimulate the sector. ALS, the company we've owned for a while there. Obviously this is a way we can gain some exposure to the gold boom. So a gold rise will lead to junior miners exploring for more gold. That necessitates drilling. That requires therefore the core samples to be tested. ALS is the largest global tester of those assay samples. And on the bottom right-hand chart there, you can see the strong correlation between equity raisings by junior miners and then the drill holes or testing required. So ALS share price is starting to respond nicely to that sort of CapEx-driven growth in that copper and gold sector. Net Wealth and Hub24, these have been a constant in our presentation pack in terms of stocks that we love to own. We still see strong upside. The simple or the most simple question I get on these two stocks is, well, isn't it too late? Aren't their valuations already very, very rich? So I thought I'd put together this straightforward chart, just highlighting that their PE relatives to the market haven't changed in the best part of 7 or 8 years in the time we've owned the stocks. So they were always expensive. They're expensive when we bought them in a literal PE sense, as they are today. So it turns from valuations to prospects, which is what drives share prices. In other words, what's the size of the TAM? What's the size of the growth? What's the risk around actually taking further share in the market? And remembering that Hub and Net Wealth have enjoyed the growth by taking money from the legacy platforms, so the sort of the clunky platforms largely owned by the banks, where money wasn't invested in improving the functionality of those platforms. And Hub and Net Wealth obviously spent the money. The client service is great, and that's led to that money churn from those older platforms to Net Wealth and Hub. That's just the money that's on the platform. There's also obviously a lot of money off platform that will continue to move on the platform they'll enjoy over time. And that to the question of growth, you can see it on the left there, advisor penetration in both Net Wealth and Hub, and how Hub is certainly resonating with advisors and growing stronger than Net Wealth, which is how we're positioned in our fund as well for some time now. We've had a larger weight in Hub than Net Wealth. So just a couple of stock stories here of stocks that we've sold. Often it's quite instructive to understand the sell discipline with some examples. And it really is just the reverse of the buy discipline. When things have changed in terms of the operating conditions or the valuation, then as an active stock picker, we'll recycle that money into some other company where we see an inefficiency in its pricing. So Propel Funerals is a stock that we've owned for a long time. It's done very well for us. I think its prospects were a little clouded by COVID and what the true death rate was in terms of the ABS regressed trend line. And we did now it's returned to that trend line. We did a lot of forensic type accounting work on just the makeup of their earnings, which unveiled that EPS growth has been about 4% per annum since they listed. For a company on a P of 30, we now feel is truly overvalued. When we first bought this, was on a P of 16 or 17, had a balance sheet with very little debt, and it was buying businesses on 6 or 7 times earnings. Now they're buying them at 11 times earnings. So a lot's changed. And as I said, not only is the earnings growth quite anemic, but the valuation's re-rated, and the CEO has also recently departed, which can be a little bit of a red flag. And then equity trustees, stock that we've probably called to over the last 2 or 3 years, but it had still been a top 10 holding in the fund. Probably the most obvious standout from this page is just the timing of our departure from the register of equity trustees. That was totally dumb luck in terms of the fall in the share price has resulted obviously because of their involvement in the First Guardian managed investment scheme, where the ASIC are suing them. The reason we sold out of it was simply that their costs that are how they're having to bear in terms of IT, compliance, regulatory, have really chewed up a lot of the growth that they've enjoyed from a revenue perspective. So that's that led us to re-rate our DCF and therefore trigger the sale. And then just finally, our usual top 10 holding chart for the fund, some of which I've just spoken about, and some of those stocks will be familiar from prior sessions that we've had. Our turnover in the fund generally is quite low. We only average about 40% per annum. So we hold companies on average for 2.5 years. So with that, Adam, I'll happily hand over the session to Q&A.
Awesome. Thank you very much, Steve. We have received a few questions already. I will start with those. But just a reminder, if you have any questions, please enter them into the Q&A box. Steve, first question is that your investment process has always been heavily focused on company visits. Do you still visit as many companies in person, or are the interactions now primarily virtual?
So obviously post-COVID, we all learnt to conduct meetings virtually. And I think that a lot of CEOs, management teams, particularly through reporting season, are now seeing a fair amount of efficiency by not having to jump on an aeroplane and conducting those online. So it's not always our choice. We much prefer to have a face-to-face meeting with management. But if we've built up a rapport, we know the company already, then often a virtual meeting will suffice. But specifically to your question, at a guess, I think through the month of August, where we would have seen probably 40 companies, maybe slightly more, I would have thought probably about half of those were now online. Obviously pre-COVID, that was 0.
And from the online meetings, what do you miss out on if you aren't out there kicking the tires? Is there nuance that you just don't get?
Well, I just don't think there's any substitute for seeing the white of the eyes of a CEO and CFO. There's just nuances that you can pick up on that I think are harder to recognise virtually. So it's a stronger relationship. As I say, we're big on doing rapports and trusting management. I think you just get a greater insight if it's face to face. But that said, it's efficient, even for us, be able to run a virtual meeting where you've got your files and your notes. It also has a fair amount of efficiency to it, not having to travel. So we'll seek out when we're pushing to meet companies for the first time, then we'll go out of our way to ensure that it's a face-to-face, and often that means we'll go to the premises of that particular company.
Understood, pros and cons. You mentioned the IPOs. Have you participated in any of them? I know you have historically been skeptical.
Correct, and there isn't a lot to participate in, to be frank. There's 2 or 3 that have that came forward, non-deal roadshows that hadn't been committed, no prospectus had been lodged for the ASX, and just through lack of interest, they didn't see the light of day. So I think it is interesting that in a market that's setting record highs, that'd be typically a conducive environment from which private equity firms and vendors would look to exit, but the appetite has not been strong. And part of the reason for that is, I think there's plenty of investors that have been burnt by, particularly through just out of COVID. There was quite a few, and I might have mentioned it in one of the slides earlier. There's quite a few companies that had listed coming out of that COVID period with very ambitious growth expectations that I think were propped up by COVID gains that are now unwound. So stocks like Adore Beauty, I mean, its share price will be off 80%. When consumers were stuck at home with virtual meetings and Zoom calls, they typically buy a lot more of Adore Beauty's goods than they do now when they go back into the shop. Adore Beauty doesn't have a bricks and mortar presence, although they're moving into it shortly. So that's off 80%. Peter Warren, which is a car dealership, it's off best part of 40%, simply because they were over earning in terms of lack of new cars, meant there was high margins there that have now reverted to normal. And Redox is another one, a chemical business that was just benefiting. So I think that there's probably a few scars there. And then just as an overlay, as a vendor, of course, that now the compliance regime and being a listed entity, particularly as it relates to non-executive directors and their liabilities and the cost, insurance, etc., is not what it used to be 10 years ago. So it's not as easy to float a company as it was back then as well. And yeah, to your first observation, correct. We don't invest, well, typically we don't invest in IPOs at the beginning, but it's a great opportunity to get to know an industry, get to know a company, and it can be very fertile ground for investing 2 or 3 years down the track once the business is settled and they've moved through that prospectus forecast period. So hopefully it opens up soon.
And M&A, do you think that we could see an increase there? Could that lead to a re-rating in the sector?
Well, it should, yeah. So this is cost of equity low, with given potential Ceres share prices are high. It can be a very EPS accretive approach to growing inorganic growth. So that's now's usually the time that you start to see that playing out, and also interest rates are low. So the cost of borrowing to acquire is manageable, and the Aussie dollar's at relatively low level compared to history. So, would-be overseas buyers could also mount a case to acquire in Australia. There's been a few cases, but I wouldn't be surprised over the next 12 to 24 months if markets stay buoyant that'll be absolutely a feature.
Yeah, makes sense. You spoke a bit about the AI hype, but to what extent are you concerned about existing business models being undermined by AI technology? Particularly, I would add in the sort of SaaS space.
Well, I think I know where you're going with the question, but my bigger concern is that existing businesses' work practices are unravel to try and lean into AI, and that the return or the benefits for AI are simply not there at the moment. And so they can almost shoot an own goal by being an early adopter when their current business practices are working perfectly well. And there's a study done by IBM of I think it was the top 300-400 CEOs in the world that have spent money on AI of these large corporates, and less than 25% of those CEOs, when questioned, are now had to lower their ROI guidance assumptions on that justification of spend, because of the fact that there is a lot of errors. Without getting into too much detail, there's a lot of what they call hallucinations or errors or made up answers that chatbots will give you in AI, and that can lead to errors in businesses in terms of relying on accurate information. So that's why AI is usually mostly been adopted at the moment for an automated type solution for call centers, back office, where those errors can be managed and triaged rather than relied upon. So I think undoing proven business practices is the risk in terms of existing companies leaning too much into AI. And then as it relates to where I think your principal question was in terms of revenue being replaced or existing businesses being made obsolete or redundant because of AI, it's just too early. The moment, for instance, even the Australian market, the only real exposure to AI you can gain is through the data centers. There's a couple of small non-profitable tech companies that are listed that are in the AI space, but they've yet to really prove up their the user cases, products to sell in the market. So we'll watch it closely, and certainly not naive to the fact that AI is real. It's potentially a platform, if not, it's certainly powerful software, and it's a cycle which is, as I said, we're not sure if it's at the start in terms of how capital markets are assessing it or towards the end. But either way, if it stays where it's at, there'll be a lot of IPOs coming to market like there was in 98, 99, looking to bank the hype. And they'll come via our boardroom in terms of small industrial companies looking to come to market. And we certainly won't be investing in those without cash flow delivery.
Okay, thank you. To what extent is the VIC weakness a convenient excuse for companies that have disappointed shareholders?
That's a good question. I could easily be. There's no doubt that it's real in the sense that that confidence is low and taxes are real and extra costs of business are showing through in the results. But equally, as we've learned from be it Y2K or COVID, there's plenty of the company that will put forward excuses as to why they've had poor operating delivery. So that's for us to talk to them about and quantify when we meet companies as the real effect of it. But no, it's a pretty decent question actually.
Next question, and I never know how to pronounce the name of the company, so I'm just going to say TUA. To what extent are you invested? What is your view on the company?
TUAS, yeah, so it's one of the main brands in the Singaporean telecommunication market in broadband and mobile, and they've just taken over one of the biggest competitors there. So now there's 3 key players in that market, which is a pretty cozy operating environment from which to build out a business with good margins. David Teo is the brains behind the operation. For some will remember, he set up TPG, but obviously a very successful telecommunication business in Australia, started that from zero. So we'll back him. It's done well. It's already done very well. Probably our greater concern is valuation. So we don't get too carried away with that, the size of our weight in the fund. But certainly the hallmarks of a very successful investment are in place with a sensible competitive backdrop, fast-growing market, fast-growing industry, and with a proven performer in terms of David at the helm. So we model it out. We still see strong upside, albeit less than it was. So the weight it's about a 1% weight in the fund, to put that in perspective.
Right. Your number of stocks from New Zealand in the portfolio, notwithstanding you flagged weakness in New Zealand. Anything special that contributes to this exposure? Is there a lack of opportunities in Australia?
Well, it really just comes down to valuation. So we'll stare down sort of economic risk if we think it's in the price, and our exposure through whether it be through main freight or Freightways or EBOS, Channel Infrastructure, I think they're the 4. We feel that the the economy is in a position now from which to rebound, and those companies will all get a benefit from it. And we don't see it in the price. So, Freightways is a really good example, where as a freight courier business in New Zealand, it's very exposed to the New Zealand economy. And any uptick in the economy, they're going to see incredible growth flow through. To put that in perspective, since before their economy fell away post-COVID, volume has fallen 9% across their network of delivery. Now, with the fixed cost base of trucks and drivers, the leverage of that to the bottom line in terms of cash flow delivery is enormous. So that's how we model it. We don't think the market is modeling it that way, or the share price reflects that, which is why we've got a position in the fund.
My next to last question so far is that the platforms are increasingly under pressure. Macquarie has just paid, or is paying, 320 million to compensate Shield investors, and we know they aren't the only platform to have this exposure. Is there anything to worry about in that space?
Oh, there's a lot to worry about. Yes, absolutely. I mean, the blowtorch from the regulators and ASIC has really firmly been put on that whole space and all the operators in that space, and no doubt it will result in obviously the work through all the messy losses now, which is incredibly unfortunate for the 3,000 odd retirees. Well, soon to be retirees, but there'll be a lot of extra oversight and cost to bear, I would have thought, from all participants in the market, platforms, trustee companies, advisors, to ensure this doesn't happen again. First point. And then the second point is, well, what's the upfront cost here to in terms of being sued by ASIC or to make good? And Macquarie have obviously stepped forward with a make good solution. Equity trustees, we're not involved with anymore. The one in Hub has no exposure, and Netwealth does through First Guardian, and I mean their exposure has been spoken about to be about $120 million in terms of money put into put through their platform into the superannuation scheme. And if they were to do Macquarie and agreed to a make good for all money lost, and let's say only half of the money's reclaimed, then that's about a $60 million exposure, worst case, if that's what they did. Now, remembering Netwealth's market cap is $7.5 billion. So it's a bit of a rounding error in terms of the valuation of their exposure. But you've seen the share price gap between Hub and Netwealth really widen because of their exposure to the tune of 15 to 20%. So it's markets have certainly have got I think a little bit overexcited about the specific exposure of Netwealth to obviously what is a very troubling outcome in the superannuation space.
I guess it might be less about the specific Shield remediation and more about the ongoing pressure that the sector could be under from particularly ASIC as a result of this.
Yeah, and as I said, there's no doubt there'll be extra cost, compliance to ensure that this sort of event doesn't happen again. That we will have to allow for in our assessment of the worth of these businesses.
Thank you. And our last question that we have for today is looking at long-term positions like Hub and Netwealth, ironically. How active are you with trimming, and is that usually, and what is usually the main reason for reducing the size of a position?
It generally is valuation driven, but not always. So Netwealth and Hub 24, we've been trimming those continually. In fact, we didn't trim them over the last 8 years. They'd probably be about 20% of the fund each. They're not. They're both about 2.5% of the fund. So we keep trimming But it all comes back to a valuation thesis in terms of share price versus what we think it's worth and the risks to our assessment of that valuation in terms of the position and the weight in the fund. And that's a day-by-day proposition where Ed and I will look at the portfolio and make judgments on that and change as required. Now, so generation developments is another highly successful story for us over the last 12 months. Our weighting in that has also reduced just as the share price has risen so far. But there could simply be that we were dramatic there with equity trustees and Propel Funerals in terms of selling every share. There were two companies that were this time last year were top 10 positions. In fact, Propel was, I think, third largest weight in the fund this time last year, and where we sold those totally, that was due to a total assessment of the worth of those businesses, and that can happen as well. So yeah, it's pretty dynamic. Can be a lot of reasons for positioning change, but the share price change is probably the most common.
Right, thank you, Steve, and thank you to everybody else who submitted questions. The questions do really make the webinar, and today I think that there were some very good ones. If you have any other questions which you didn't ask today, please get in touch with us directly. We always love to hear from our investors. Once again, thanks for joining us and enjoy the rest of the afternoon.